Welcome to this explainer of the LNG Trading Desk Master Program. I'm a consultant with Thurga Analytics, and with decades of experience sitting on both the physical and financial sides of the LNG market, I am absolutely thrilled to be taking you through this journey. Now, we've got a massive sequenced roadmap ahead of us, 9 modules and 120 chapters. We're going to cover everything from market structure and senior trading playbooks all the way through to valuation, risk, shipping, ETRM systems, regulation, and finally, desk leadership and legacy. But right now, we're kicking off Module 1, Chapter 1, What an LNG Desk is Accountable for. And we're going to start by shattering a very dangerous illusion. The idea that an LNG cargo is just a flat price bet blinking at you on a computer screen. Honestly, if you only take away one single truth from this entire 120-chapter program, let it be this fundamental duality of the LNG craft. Because depending on the day, you're either running a logistics business with a derivatives overlay, or you're running a derivatives business with a massive logistics liability. Grasping that duality, that's your key to actually surviving on a desk. So, here is our roadmap for today. 1. Welcome to the desk. 2. 2 desks, 1 market. 3. The 3 accountabilities. 4. 5 sources of result. And 5. The physics of risk. All right, part 1. Welcome to the desk. The illusion versus the reality. Think about your dual monitors for a second. The financial side of your desk measures itself in dollars per MMB2, and it settles neatly in cash, nice and clean, right? But the physical side? That side is measuring cryogenic liquids evaporating inside a pressure vessel. It deals in cubic meters, gross heating value, lake hands, and berth slots. It only settles when a massive ship actually ties up. If your desk doesn't know which of these 2 descriptions your systems are reporting, you're effectively flying blind. Let's talk about where title passes, because it changes everything. Take an FOB, or free onboard purchase. Title passes right at the loading flange, meaning your desk assumes the entire risk of that voyage. Now compare that to a DES, or delivered ex-ship purchase, where title passes at discharge, meaning the seller owns the voyage. It's literally the exact same cargo, the exact same molecules moving between the exact same 2 ports, but it's a completely different exposure set. That Incoterm completely dictates your true accountability. Moving on to part 2. 2 desks, 1 market. Permissions versus demonstrations. Throughout this program, we are always going to view things through 2 distinct lenses, the US desk and the EU desk. They trade the exact same molecules but play by totally different rulebooks. The US desk typically sells FOB out of the Gulf, prices against Henry Hub, and primarily acquires permissions like DOE export authorizations. You get those once and you just check them per transaction. But jump over to the EU desk, they're buying into Europe, pricing against TTF, and they have to acquire demonstrations, like strict origin verification, and you have to reproduce those demonstrations for every single cargo. This means these 2 desks answer to different regulators, use different infrastructure, and crucially, fail in fundamentally different ways. And speaking of failing, here is a classic trap. It's the distinction between position and exposure. Beginners collapse these 2. Senior traders do not. A position is just what you hold. An exposure is what that holding actually does to you when something moves in the market. You could have a position that looks perfectly flat in the system, while it's hiding a massive structural exposure underneath. Let's hit part 3, the 3 accountabilities. The framework of survival. You hear it all the time. Traders are accountable for P&L, risk, and reputation. Well, actually, reputation is the wrong 3rd item. You are accountable for P&L, the true economic result, not just whatever accounting number your system spits out. You are accountable for risk, the actual exposure you hold. And you are accountable for conduct, how you obtained that result. Reputation? That's just a consequence. It's simply what happens to your firm when your conduct fails. So we have to separate accountability from control. Think about where the machinery actually breaks down. A desk head is accountable for position size, sure, but the risk function sets the limit. The failure almost always happens when a control is specified in the units of the financial business, say MMBTU, and then incorrectly slapped onto the physical operations. Because over there, your binding constraint isn't a financial limit, it's the actual number of available vessels.
Okay, part 4, 5 sources of result. Deconstructing the P&L. Ask a trader where their money comes from, and they'll usually give you one answer: the spread. That's a total illusion. A cargo is absolutely not one flat price bet. It's a composite of distinct sources of result that behave, hedge, and fail completely differently. Managing an LNG desk means actively trading 5 specific elements. You've got your flat price on open length, you have the basin spread, you have time spread and storage, you have freight and boil-off, which, by the way, is way too often mismanaged as a static cost rather than an active position, and 5th, you have contract optionality. You have to actively trade those 5 while ruthlessly defending against a 6th element: operational variance. That is the physical leak between the trade you intended to do and the reality of what happened.
Finally, part 5. The physics of risk: shrinkage, force majeure, and shipping.
3.418%. I want you to burn this number into your brain. This number is the exact volume of your cargo that you paid hard cash for, but which will physically never arrive at its destination. Walk through the math with me. Say you're on an FOB purchase using a modern standard carrier. You pay for over 3.8 million MMBTU loaded. But over a standard 20-day voyage, you're losing volume to boil off, and you have to retain a heel just to keep the tanks cold. So you deliver exactly 3,747,579 MMBTU. That is a physical shrinkage of 132,621 MMBTU. At typical market prices, that shrinkage alone is costing you over $800,000 per cargo. If your ETRM system is just recording one static volume field for a cargo, it is straight up lying to you. And that physical reality, it directly messes with your hedging. If a U.S. desk buys feed gas at Henry Hub and sells at TTF, they're facing a 1.1907 hedge ratio. Why? Because you have a contractual 115% feed gas multiplier at the plant, plus that 3.418% physical shrinkage on the water. So a simplistic one-for-one hedge of an index purchase against an index sale is structurally wrong. It leaves you with a massive unhedged residual position that will just bleed P&L. Think about the life cycle of a cargo. From the initial deal to nomination, loading, the voyage itself, and finally discharge. As you move along that timeline, your optionality shrinks drastically. At every single handover, the group of people who can actually change the outcome gets smaller, while the cost of changing your mind absolutely skyrockets. Which brings us to a brutal reality check regarding force majeure. You have to internalize this asymmetry. Treating a purchase and a sale is perfectly offsetting just because the volumes match on your screen completely ignores legal reality. Very often, only the supply side can cancel on you without penalty due to a plant event. So if your supply cancels, but your downstream sale agreement does not excuse you, your perfectly flat paper position just turned into a catastrophic short exposure.
Let's bring this all home with an EU desk case study. Imagine you're holding oil-indexed length, and a severe cold spell spikes Asian spot gas prices up to $30. You perfectly predicted the market. Incredible trade. But you didn't fix the ship. Suddenly, unhedged spot freight rates jump to $300,000 a day. That freight spike just ate 61.3% of your entire expected margin. You were right on price, but you were wrong on shipping. If you do not control the steel on the water, you do not control your returns.
So, as we wrap up this explainer for Chapter 1, I want to leave you with one urgent question. If your system doesn't know the difference between a paper trade and a physical vessel out there on the water, who is truly managing your risk? You or the market? We've laid the groundwork for the physical reality of these molecules. Up next, in Chapter 2, we're going to pull back the curtain on internal governance and look at exactly who is allowed to authorize these multi-million-dollar exposures. Until then, go check your systems, and whatever you do, don't just trust the spread.
Welcome back to the LNG Trading Desk Master Program. You know the drill. This is the explainer where we take verified arithmetic and raw structural realities and turn them into desk-ready frameworks. Quick reminder, we are on a massive journey here, 9 modules, 120 chapters in total. We're covering everything from what your desk is actually accountable for, all the way through market structure, senior playbooks, risk, ETRM systems, regulation, right up to desk leadership. I'm your Dorg Analytics consultant. I've spent decades in the trenches trading physical and financial LNG across the globe, and my goal today is to ground your learning in modern, professional practice that actually makes money and survives the market. Let's get to it.
All right, we are in Module 1 today, diving into Chapter 2, Physical versus Financial LNG Desks. Listen, in this chapter, we're going to completely shatter the myth that a desk is strictly physical or financial. The reality out there is way more nuanced, and if you get this wrong, it's a structurally catastrophic, incredibly expensive mistake.
Let's take a quick look at the agenda. First, the LNG trading spectrum. 2, the obligation ladder. 3, paper versus physical capital. 4, US versus EU desk rules. And finally, number 5, the accidental physical desk. Let's jump in. Starting with Section 1, the LNG trading spectrum, moving beyond the binary trap. So, the very first question a new desk head usually gets asked is, hey, are we physical or financial? But here's the thing, answering that as a simple binary is going to misdesign your desk from day one. Every single LNG desk actually sits somewhere on a continuum. You've got pure paper on the left, spot physical in the middle, all the way over to asset-backed on the right. Your spot on the spectrum isn't just about whether or not you're moving molecules. It's defined by your optionality to exit, which drops the further right you go, and your access to the 5 result sources, which goes up as you move right. When you're purposefully choosing your position on this spectrum, rather than just accidentally drifting into one, you've got to ask these 3 sequential questions. Step 1, do we actually need freight, boil-off, or optionality? If the answer is yes, then step 2. Can we fund exactly 14.22 times the paper margin? And if yes again, step 3. Can we survive exiting a position above rung 3 of the obligation ladder? If you can't confidently answer these, you're setting yourself up for some disastrous mandate drift. And that brings us right to Section 2, the obligation ladder, quantifying your true risk appetite. Think of this ladder as your desk's risk appetite made physically and financially precise. Every upward rung represents a physical commitment. Down near the bottom, it's pretty cheap to reverse course. But once you cross certain lines, it gets exponentially more expensive to walk away. If your desk habitually operates above the 4th rung, you fundamentally decided you're okay with an exit cost that's at least 8 times the paper equivalent. Which leads us to the 14x step, fixing the discharge slot and nominating a buyer. I see desks all the time treat nominating a buyer as just some administrative checklist item for the ops team. It absolutely is not. This is literally the moment your exit cost rockets upward by 14 times. Why? Because the terminal has allocated a berth that can't be recovered, and 3 different counterparties have planned their operations around your cargo. When you delegate this step, you're delegating the decision to stop being able to change your mind cheaply. Let's look at the verified arithmetic on this for a real desk holding a standard cargo, about 3.7 million MMBTU. The contrast is wild. Exiting a cash-settled paper position, that costs you about $187,000, but look up at rung 6, where the downstream customer is supplied. The cost of a distressed replacement is nearly $10.5 million. So a standard risk report that measures exposure purely in MMBTU completely hides the reality that a downstream exit costs over 56 times more than a simple paper exit. Let's transition to Section 3, paper versus physical capital, the cost of reaching result sources. We really need to anchor this in some hard numbers by looking at the exact same market view. Say, betting on the JKM TTF spread widening, but expressing it financially versus physically. The asymmetry here is lethal. A financial expression means risking a known margin call against a position you can just close. But a physical expression, that carries the severe liquidity risk of a failed discharge. And a failed discharge is a demand for performance you simply cannot supply at any price you control. They are completely different beasts.
Here's the verified number every LNG professional needs to internalize right now, 14.22. That is exactly how many times more capital it takes to fund the cash out at load for a physical cargo compared to the equivalent paper margin. To put that into perspective, you are putting up roughly $24 million in cash versus just $1.6 million in margin for the exact same market view.
So you're probably thinking, why on earth would any desk pay that 14x multiple? Well, as painful as it is for our capital requirements, it's the absolute price of admission to access logistics and optionality. Physical desk advantages include capturable freight, boil off, which is unavoidable anyway, and contract optionality, which is your principal source of value. A purely financial desk just can't touch those. And in LNG, those physical elements make up roughly 2/3 of the total value over a cycle. If you want the lion's share of the profit, you literally have to play the physical game.
Now for Section 4, U.S. versus EU desk rules. Two distinct regulatory realities. Moving right on the spectrum has massive regulatory consequences, and under the Durga Analytics method, we always look at this through our dual US and EU desk lenses, because frankly, they fail in entirely different ways. The defining structural contrast you need to memorize is this. The US desk primarily acquires permissions to trade. You get them once, and they're checked per transaction. The EU desk, on the other hand, acquires demonstrations. These must be actively reproduced and verified for every single cargo. This fundamentally changes how you have to build and resource your middle office.
Let's break down the US desk spectrum triggers. Moving from paper to physical here means your regulatory exposure just explodes. Suddenly, your export authorization under the Natural Gas Act becomes binding. You have dual anti-manipulation exposure, answering to both the CFTC and FERC. And your sanction screening, it extends way past just your counterparty. You now have to rigorously screen the actual vessel, the owner, the manager, and the flag. Now, look at the EU desk spectrum triggers. Here, the burden is a recurring middle office nightmare. Because the compliance duty is placed squarely on the importer, you have to verify cargo origin for every single delivery. You have to demonstrate methane MRV, monitoring, reporting, and verification equivalents at the producer level for gas you didn't even produce. And suddenly, your regas capacity fees become a massive balance sheet item. And speaking of regas capacity, here is a $14,400,000 operational leak that drives me absolutely crazy. EU desks routinely leave over $14 million on the table every year. How? By treating a booked regas slot as a sunk cost. They divert a cargo to Asia, and they just fail to release the unused terminal slot in Europe. On a 20-slot program with a 60% recovery rate, you're losing over $14 million just because someone skipped an administrative task? And worse, under EU use it or lose it rules, not releasing that slot can literally trigger a regulatory breach.
Let's tie this all together with Section 5, the accidental physical desk, the danger of mandate drift.
This happens all the time. A desk is mandated for paper, but one quote-unquote reasonable decision at a time. A short-term charter here, a cheap regas slot there, they drift into physical risk. Look at this table. The standard risk reports asked, what is the position, and answered long 3.7 million MMBTU. The report said it costs around $187,000 to exit, and nobody else needs to agree. But the latter gives the true answer. The actual position was one load-in cargo, a slot, and a charter. The real cost to exit was over $1.3 million, and it required the terminal, the ship owner, and the buyer to all agree.
As this quote perfectly captures, the failure here is not that the desk took physical risk. It is that nobody was accountable for the transition because the transition was never an event, it was a drift. Ultimately, taking physical risk is a great, profitable business decision. It's how you grab 2/3 of the market's value. But it absolutely must be a mandated, capital-allocated choice, never an invisible drift.
So, before we wrap up, I want to leave you with this question. Look at your own desk's operations today and be brutally honest. Place your own desk on the spectrum. What rung of the obligation ladder do you habitually operate above? And when the market turns against you, who really controls your exit? Do you actually know your true cost to reach flat?
Up next, Module 1, Chapter 3, Portfolio versus Asset-Backed Trading. That wraps up our deep dive into the spectrum and the obligation ladder. Next time, we're heading to the far right of the spectrum to tackle portfolio versus asset-backed trading, and we'll learn how to price the single most valuable option in LNG. I'll catch you in the next explainer.
Welcome back to the LNG Trading Desk Master Program Explainer. I'm your host, an LNG trading and risk management consultant from Durga Analytics. Over the decades, I've lived exactly what we're going to talk about today, trading physical and financial LNG out of the U.S. Gulf and into Europe and Asia, building durable desks, designing ETRM systems, and teaching teams how to navigate the absolute chaos of this market. Now, as a quick reminder, this master program is a sequenced journey. We're moving across 9 modules and 120 chapters, taking you from desk accountability, market structure, and ETRM systems, all the way to regulation and legacy. Today, we're diving into Module 1, Chapter 3, to unpack the absolutely critical differences between portfolio and asset-backed trading. Let's get into it.
Here is our roadmap for this chapter. First, the asset-backed reality. Second, the sunk cost trap. Third, the U.S. desk and cancellation rights. Fourth, the EU desk and the mirror commitment. Fifth, measuring true performance. And finally, our takeaways and next steps. All right, let's jump right into Section 1, the asset-backed reality. So let's start with a foundational first principle. Separating a portfolio position from an asset-backed one is based entirely on one thing: where the cost sits. It doesn't matter what your desk calls itself. As you can see across these 5 key dimensions, the asset-backed desk is making a very specific trade-off. You are giving up some of your destination flexibility and freight control in exchange for volume certainty. Your downside, say if the market suddenly closes, is strictly bounded by a number agreed upon years earlier. That means a substantially higher level of committed capital. To put it a bit more bluntly, a portfolio desk only buys when it actually sees value in the market. Between trades, it owns nothing. An asset-backed desk, on the other hand, has contracted for capacity. Whether that's liquefaction, shipping, regasification, or storage, you pay for it whether you use it or not. Literally everything else we do on the desk, from our analytics to our trading playbooks, follows from that one fundamental structural difference. Moving on to Section 2, the sunk cost trap. Now, this brings us to a massive psychological trap that routinely destroys value on the trading desk. It's the classic mistake of treating fixed, sunk costs as marginal costs. Picture this. You've got a U.S. desk holding liquefaction offtake for, say, 20 cargoes a year. Bam! You are hit with a fixed fee of over $194 million on January 1st. And that happens before you've even made a single trading decision. Let's break that math down per cargo. That $94 million annual fee equals exactly $9.7 million per cargo. Now, because that $9.7 million is completely sunk, you owe it no matter what, an asset-backed desk must strictly look at the variable cost, which is around $14.2 million, and the freight, around $2.2 million, to decide whether to lift a cargo. The fixed fee has absolutely no mathematical place in your lifting decision. None. But you know how humans are. Ignoring that basic day-one textbook rule of sunk costs leads to what we playfully, or maybe not so playfully, call the result that gets people fired for being right. It's one of those rare places in commercial life where your textbook math is flawlessly correct, yet it will routinely get you screamed at in the boardroom. Let's actually run the numbers to see why this happens.
Which brings us to Section 3, the U.S. desk and cancellation rights.
Remember our recurring rule for this program. A U.S. desk mostly acquires permissions. You get them once, and you check them per transaction. Here, the U.S. desk holds a crucial permission tool, the cancellation right. So imagine you're sitting at your desk. Your CFO storms in, face red, demanding you stop lifting cargoes immediately. Why? Because the European benchmark, TTF, is at 550, and your program is bleeding $111 million across the year. So what's your immediate action? Do you cancel?
Well, you have to calmly look your CFO in the eye and explain that keeping the cargoes flowing at TTF 5.50 still returns over $4.1 million above the variable cost per cargo. Canceling right now actually destroys value. If you cancel, you yield absolutely nothing, zero. But guess what? You are still legally bound to pay that $9.7 million fixed fee per cargo. Yes, the desk is losing money overall, but the correct action is to keep doing the thing that loses money because the alternative loses more. You are only mathematically indifferent at a TTF of about 440, and you only actually hit the cancellation button when it drops down to 390.
So, to operationalize this on a real functioning desk and keep human emotion out of it, your quants need to build a clean 30-line cancellation decision engine in your ETRM. This engine compares the lift margin strictly against zero. The golden rule here: never ever let the fixed fee taint the logic. If changing the fixed fee in your system somehow changes your lifting decision, your tech is fundamentally broken, and it's going to tell you to cancel profitable cargoes all year long. Let's cross the Atlantic for Section 4, the EU desk and the mirror commitment.
We need to draw a hard structural contrast here. Where the U.S. desk acquires permissions, the EU desk acquires demonstrations. They have to reproduce these demonstrations for every single cargo. So while the U.S. desk holds an unlifted cargo fee that is strictly bilateral and totally unrecoverable, like a put option, the EU desk deals with a mirror commitment, booked regasification capacity. The brilliant structural difference is that the EU desk's unused capacity is often tradable. It can be released or resold in a secondary market, making that sunk cost partially recoverable.
Understanding exactly what option you hold is a matter of survival. Look at this breakdown. We have tolling on the left, which gives you that clean cancellation right. On the right, capacity booking gives you the right to release or resell, but be incredibly careful of the equity trap right there in the middle. Desks that upgrade from tolling to equity often mistakenly carry their old cancellation assumptions with them. Big mistake. An equity off-taker is a seller. They own a share of the plant. They hold absolutely zero cancellation rights to capture downside if the market closes. It's a completely different risk profile.
All right, Section 5, measuring true performance.
Because these structural commitments so deeply alter the underlying math of your desk, correctly measuring your team's performance is crucial. Take the return on allocated capital, or ROAC. For the exact same desk, with the exact same assets and trader competence, look at how the return swings. It goes from a massive 32% gain in a wide regime, down to about a 6% gain in a normal regime, to a devastating 17% loss in a narrow regime. And this happens based solely on market spreads that your traders have literally zero control over.
So, to prevent your management from unfairly penalizing trader skill for macro regime shifts, you must report two distinct numbers. First, the trading result, which asks, did the desk optimize the cargoes it was given? That's what you control. You keep that entirely separate from the program result. The program result asks whether signing that massive 20-year offtake was a good decision in the first place, a fixed fee commitment often dictated by executives who probably don't even work at the company anymore. Reporting just one blended number conceals both the skill of your traders and the cost of the asset. And that brings us to Section 6, takeaways and next steps.
Let's distill this down into core survival tactics for your desk. Always, always strip fixed fees out of your marginal lifting models. Recognize the structural divergence. U.S. cancellations act as put options, whereas EU unused slots require you to actively test the secondary market before you declare the cost totally sunk. And critically, especially for you risk managers out there, ensure massive fixed cash obligations are kept strictly out of your value at risk limits. A fixed fee is a certainty, it is not a market risk position.
So, we've covered what the desk answers for and what a prior structural commitment does to its decisions. But that brings us to a massive cliffhanger for Chapter 4. What happens when a multi-million-dollar LNG cargo is literally on the water and the deadline is set by the vessel's physical position rather than by a neat market close? When the clock is ticking, who on the desk actually possesses the true authority to make that final destination call? Join me in the next explainer as we answer exactly that. See you there.
Welcome back to the LNG Trading Desk Master Program. I'm your lead consultant from Durga Analytics, and I am thrilled to kick off another explainer with you. Let's do a quick reset on our roadmap. This program is a sequenced journey across 9 modules and 120 chapters. We're taking you from what an LNG desk is accountable for and how EU and US desks are actually governed, all the way through market structure, senior trader playbooks, valuation, risk, shipping, ETRM systems, and finally, desk leadership. Everything is built around real markets, real numbers, and verified arithmetic. Right now, we are deep into Module 1, Running an LNG Trading Desk, and today we're tackling Chapter 4, Senior Trader versus Junior Trader Authority. And look, I want to hook you right out of the gate with a reality that breaks a lot of traditional corporate assumptions. Escalating a $9 million decision to your absolute best, most experienced trader can actually destroy value. Let's get into it. Okay, here is our masterclass agenda for today. 1. The myth of authority. 2. Ships dictate deadlines. 3. The brutal cost of delay. 4. When escalation destroys value. 5. The desk-ready structural fix. And 6. U.S. versus EU reserve decisions.
Section 1. The myth of authority. We're starting with the absolute first constitutional principle of desk design. We have to separate the person from the process. Authority is a property of the decision itself, guys, not the seniority of the person making it.
Check out this 4-part framework we use to allocate that authority on a working desk. Propose, decide, veto, and be informed. The golden rule, the one that holds this entire structure together, is sitting right there in the second box. For any given decision, exactly one person holds decide. Just one. Not a committee, not a senior trader with the desk head CC'd on an email to cover their bases. Actually having 2 decide boxes is a fatal structural flaw. And the terrifying part is, this defect remains completely invisible as long as those 2 people agree. It only blows up in your face on the day a real crisis hits, when the call is agonizing and the deadline is literally breathing down your neck.
Which brings us to the veto, a tool that gets horribly abused on poorly designed desks. A legitimate veto is narrow, like a scalpel. Say a scheduler stops a diversion purely because physically the ship cannot make the terminal. That's a veto, and it is perfectly legitimate. But if they block it just because they disagree with the commercial choice of the terminal, well, that is a disguised second decide. It's wearing a veto's clothing, but it completely destroys accountability and will paralyze your desk.
Section 2. Ships dictate deadlines. We need to pivot now and talk about why physical LNG is a totally different beast than financial trading. The authority structures that work beautifully in financial markets will absolutely sink you in physical LNG, and it all boils down to physics.
So the core difference is this massive asymmetry. Financial markets wait, physical ships do not. If you defer a decision on a financial desk, what does it cost you? A price move, right? It's symmetric and often manageable. But on an LNG desk, deferring a decision triggers a one-way loss of a physical option. Once that vessel passes a specific routing point in the ocean, a specific destination is just gone. It's no longer reachable within the laycan. That option expires whether your team has made a decision or not. The deadline doesn't belong to the trader, it belongs to the ship.
Section 3. The brutal cost of delay. Let's put some real math behind this value decay.
We're going to use our running cargo diversion case study from earlier chapters, where we locked on to an $8.45 million advantage in sending a laden cargo to Asia instead of Europe.
I really want this number to hit you hard. $90,175.65. That is the exact, literal hourly cost of delaying a diversion decision. Let me be clear, this isn't some theoretical estimate of regret, and it's not an accounting penalty. This is the hard, measured rate at which the value of your physical option evaporates while your desk sits around not making a decision. Every single person on a working desk needs this number burned into their brain. Let's crack open the verified arithmetic so you can see exactly how we get there. Say the decision is deferred for 48 hours because someone wanted to escalate it to management. Well, the ship kept moving. So rerouting now adds 11 extra steaming days at roughly $85,000 a day. That right there is $935,000. On top of that, the late arrival pushes you out of your optimal pricing window. You price lower by, say, 90 cents per MMBTU. On a standard cargo, that's going to cost you roughly $3.39 million. Add it up. In just 48 hours, simply delaying the decision eats over $4.3 million. That's more than half of the cargo's entire commercial advantage. Gone. Divide that by 48, and there's your $90,000 per hour decay rate.
Section 4. Why Escalation Destroys Value. Okay, this is where we challenge desk dogma. We are going to take a hammer to the traditional corporate instinct that says big, expensive decisions must naturally escalate to a more senior, experienced trader.
We can prove mathematically that escalating to a quote-unquote better decision maker can actually bleed the firm dry. Imagine your senior trader is genuinely great. Let's say they're 5 percentage points better at making this specific call than your junior trader. But escalating takes 6 hours of elapsed time. Okay, 6 hours at our $90,000 decay rate, that is a guaranteed sunk cost of over $541,000. Now, what's the expected value of getting a 5% better decision on an $8.45 million cargo? It's only about $422,000. Do the math here. Does that slightly better decision save you? No way. You just locked in a net loss of over $118,000. Escalating wasn't just a bottleneck, it was commercially wrong. Take a look at the shaded region on this chart. That whole area represents where escalation actively destroys value. And I'll tell you from experience, that covers almost every single decision a physical desk faces on a daily basis. Unless the value at stake in the decision is north of $10.8 million, escalating for 6 hours is just mathematically unjustifiable.
Section 5. The desk-ready structural fix. So how do we actually fix this? If a desk manager tells you, oh, we just need to hire better junior traders, they are completely missing the point. Hiring takes months, and frankly, it doesn't change the physics of the vessel on the water. The only lever you can pull right now to survive is shortening the escalation duration. Look at this table and honestly evaluate your own desk's authority document. If you can simply halve that escalation time, take it from 6 hours down to 3, you brutally slash the cost of delay. Suddenly, that exact same 5% improvement in decision quality from your senior trader turns a $118,000 loss into a $152,000 net gain. You just generated massive value, and absolutely nobody on the desk had to become a better trader to do it. Let's see what this looks like in practice. You don't need some massive multi-million-dollar IT overhaul to shorten escalation time. What you need is a workflow that does the heavy lifting before the opportunity even pops up. A trigger price prints, a standardized decision pack is automatically spit out, and a named holder is genuinely reachable on a rota. Every single box on the left side of that authority transfer exists for one reason: to ruthlessly compress elapsed time.
To really drive this home, let's walk through a composite case study that I've seen play out far too many times. A juicy diversion opportunity hits at 3:40 a.m. on Saturday. The desk has this supposedly exemplary authority document. But guess what? The desk head is asleep, and the named deputy isn't actually on a formal weekend rota. It takes until 9:15 a.m. just to get someone on the phone. Then, because they didn't have a pre-built decision pack, the team burns another 4 hours manually scrapping together the voyage plan, prices, and terminal position. The actual decision? That only took an hour and 20 minutes to make. But that completely avoidable 11-hour delay cost the desk over $1 million in physical option decay before anyone even debated the merits of the trade. Ouch.
Section 6. U.S. versus EU Reserve Decisions. All right, let's flip the script entirely. We have to talk about regulatory reserve decisions. These are strictly non-commercial decisions, and because of that, they're completely immune to the cost of delay arithmetic we just went over.
As you know, in this program we always teach both the EU and US desk models side by side because they answer to different regulators and they fail in very different ways. The structural contrast here is massive. A US desk mostly acquires permissions. Think about confirming a destination sits inside the export authorization held under Section 3 of the Natural Gas Act. You get that permission once, and you check it per transaction. An EU desk, on the other hand, lives and dies by demonstrations. They have to reproduce rigorous, complex demonstrations against heavy sanctions packages for every single cargo, confirming the country of production, clearing vessel services every single time.
And here's the critical takeaway. A commercial cost-benefit calculation is totally the wrong instrument for a regulatory permission question. You never ever ship a cargo to a destination your authorization doesn't cover just because the delay is costing you $90,000 an hour. That's how you lose your license. So how do you beat the decay? You pre-clear those destinations and reserve these decisions to a named individual long before the ship hits its routing point. Like I always say, a permission checked in advance costs absolutely nothing at 3:40 a.m. on a Saturday.
I want to leave you with a self-check for your own trading floor. Who exactly holds decide on a laden cargo diversion at 4 a.m. on a Sunday at your shop? Are they genuinely, actually reachable on a rota? What is your true escalation duration? From the second the opportunity arises to the final commercial call. Go calculate your own cost of delay. If you don't have the structural fixes we built today in place, your desk is literally bleeding value into the ocean.
And that wraps up our breakdown of authority and the brutal physics of physical LNG deadlines. Up next is Module 1, Chapter 5, Desk Mandate, Capital, and Risk Budget. We figured out who decides today, but I want you to ask yourself this. If your trader makes a decision that risks your entire capital budget in a single afternoon, does your desk even survive to open its doors on Monday? We'll tackle that exact scenario next time. Thanks for joining me on this explainer, and I'll see you in the next chapter.
Welcome back to The Explainer. I'm an LNG trading and risk management consultant from Durga Analytics, and I've spent decades trading physical and financial LNG out of the US Gulf and into Europe. Over the years, I've seen firsthand how desks fail. And spoiler alert, it's rarely from bad trades. It's almost always bad governance. Today, we're diving into Module 1, Chapter 5 of our LNG Trading Desk Master Program. As a quick reminder, this course is a sequenced journey across 9 modules and 120 chapters, covering everything from market structure to ETRM systems. But right now, we're dismantling the flawed ways desks view risk and capital by exploring mandates, invisible drift, and the absolutely crucial structural contrasts between EU and US desks.
Okay, let's jump straight into what we're covering today. 1. Mandates, limits, and targets. 2. The 5 mandate axis. 3. Capital versus credit constraints. 4. The danger of invisible drift. 5. EU versus US trading desks. And finally, 6. Measuring true desk performance. Section 1. Mandates, limits, and targets.
Look, we have to start by separating 3 documents that get constantly confused on the trading floor. Honestly, blending them together is the very first failure of governance I see when I'm auditing desks. A desk mandate is the absolute boundary of what the desk is actually permitted to do, and that is owned by the board. A risk budget is how much of the firm's risk appetite the desk may consume, owned by the risk function. And a target? That's simply what the business expects the desk to earn. Mixing these up leads to entirely different catastrophic failures.
It really boils down to this. A target is not a permission. The most reliable early indicator of an LNG desk in trouble isn't a string of bad trades, it's a target that can only be reached at the very edge of the mandate. When a desk secretly treats a business expectation as a license to widen its risk appetite, well, the foundation is already cracking.
Moving on to Section 2, the 5 mandate axes. Here's the thing. An LNG mandate that only constrains volume? It's virtually useless. Every standard desk and legacy ETRM system tracks instruments, basins, tenors, and counterparties. But almost everyone completely misses the crucial fourth axis, the obligation ladder rung. As we covered back in Chapter 2, this tracks your physical commitment level, from zero physical commitment on rung 1 to a vessel fixed on rung 3, all the way to a confirmed discharge slot on rung 5. Since the ladder rung describes your desk's operational reality rather than just a single trade's price risk, standard limit systems literally don't have a home for it. Your position might perfectly match your granted mandate on 4 of the axes, but wildly deviate on the ladder rung. This creates a massive blind spot right where your desk's survival is actually determined.
All right, Section 3, capital versus credit constraints.
So ask yourself, where does your allocated capital actually go? Say your desk is handed $650 million in capital and you're running 6 live cargoes. Your financial hedging program might consume just $12 million. Meanwhile, the sheer physical value of that cargo working capital eats up almost $144 million. And historical capitalized fixed commitments dominate the rest. Often management's attention and the actual capital are allocated in roughly inverse proportions.
This setup brilliantly illustrates why managing your desk solely based on a capital number is incredibly dangerous. With those 6 live cargoes, your capital is only 53.8% used. It feels like you've got plenty of runway, right? But check out the credit line. It's sitting at 88.1%. It's going to bind completely if you even attempt a 7th cargo. A desk managing only to capital will discover this constraint on the exact day they urgently need to trade.
When I'm designing ETRM systems for real trading floors, I absolutely insist on a one-page dashboard. You need to see capital and credit side by side, so the desk head can manage whichever one actually binds first. Crucially, you have to explicitly highlight those constraints that have no traditional limit, things like how many positions sit above rung 3 and your total cost to reach flat. Which brings us to Section 4, the danger of invisible drift.
Let's talk about invisible drift because it's a real killer. Imagine your 6 cargoes move from ladder rung 3 up to rung 5 over the course of a quarter. Maybe a buyer asks for an earlier nomination, forcing you to lock in an expensive spot charter and take on demurrage risk. The cost to exit that position multiplies by 3.39 times. Your volume, your delta, and your value at risk, they remain completely unchanged on paper. Yet, because of the physical logistics, your true operational exposure just tripled.
I have seen this exact case study play out on real desks. A desk operated for 2 whole years without a single limit breach. Then bam, a plant outage forces a sudden cargo reduction and the desk takes a $20.9 million hit because their cost to exit had quietly skyrocketed. They recorded this internally as an execution loss due to market conditions. But the real failure? Ignoring 18 months of invisible drift up the obligation ladder. The outage just finally presented the invoice.
Next up, Section 5, EU versus US trading desks. Now we have to look at how these mandates apply practically because there's a massive structural difference here depending on where you sit. A US desk mostly checks its export authorizations and tolling rights once per transaction. It's a permission-based workflow. An EU desk, on the other hand, answers to completely different regulators. It has to continuously prove regasification capacity and verify origins for every single cargo. It's an ongoing, demonstration-based workflow.
When we compare how the mandate axes actually apply in practice, the counterparty axis is the ultimate trap. For the EU desk, European methane equivalence obligations attach at the producer level, not just the direct counterparties. This means an EU desk can easily buy a cargo it physically cannot lawfully place on the market if its mandate ignores the upstream producer, leaving you with a stranded cargo. The US desk simply doesn't face this specific structural hurdle.
Finally, Section 6, Measuring True Desk Performance. Now that we've mapped out the hidden traps, how do we actually measure the desk's performance? Take return on allocated capital, or ROAC, versus margin per unit of VAR. You can literally double your desk's risk consumption, cratering your margin per unit of VAR from 17.54 down to 8.77, while your ROAC doesn't even flinch, staying perfectly stable at 32.39%. A desk reported only on ROAC can consume the firm's entire risk budget while looking perfectly stable to upper management.
But here is the real sobering reality of it all. Neither of those performance measures actually sees your contracted fixed commitments, because the models just treat them as a certainty rather than a position. A $194 million fixed cash obligation can produce a massive loss, literally 9 times larger than your entire VAR budget, with absolutely zero limit breaches and no model failure.
So, let's say you've done the hard work. You've locked down those 5 mended axes, you've controlled that invisible ladder drift, and you've perfectly aligned your capital and credit. But here is the ultimate provocative question. A perfect mandate is entirely useless if the humans ignore it. So how do you manage the behavioral risk and conduct of the traders actually running the book? Well, that is exactly what we tackle in Chapter 6. I'll see you there.
Welcome back. I'm your host, an LNG trading and risk management consultant from Durga Analytics, and this is our explainer for the LNG Trading Desk Master Program. Today, we're digging into Chapter 6, When Not to Trade LNG, and we're going to completely reframe this whole concept of not trading. It's not a missed opportunity, folks. It's actually a rigorously calculated survival strategy for your desk.
Here's our roadmap for today's. We'll start with the master program overview, move into the netback error stack, figure out the minimum tradable edge, contrast price constraints versus gates, look at EU versus US desk realities, and finally, tracking errors of omission. Let's dive right in.
Section 1. The LNG Master Program, specifically Module 01, running an LNG trading desk. Just as a quick reminder, this master program is a massive, carefully sequenced journey. We're talking 9 modules and 120 chapters in total. We cover everything from market structure and senior trading playbooks down to valuation, risk, ETRM systems, and even desk leadership. Right now, we're right at the start in Module 01, figuring out exactly what an LNG desk is accountable for. And that brings us squarely to Chapter 6. Which brings us to Section 2, the netback error stack. It is time to absolutely shatter the illusion of certainty. Okay, so you might consider a Chapter 1 US desk netback calculation of, say, $2.8089 per delivered MMB2 and think, wow, that is a perfect hard fact. But it's really not. When you break down the variance distribution, it's wild. Operations teams will literally spend hours arguing over heating value, right? But heating value contributes a measly 4.9% to the total variance. Meanwhile, freight absolutely dominates the uncertainty stack at a whopping 44.9%. It's crazy because attention on a trading desk is so often completely inverted from where the actual variance lives. The absolute key here is a mathematical concept called quadrature. Basically, when errors are independent, variance adds up. Combining them in quadrature means that a single large term dominates the total way more than its raw size would suggest. Think of it like this. Carrying one massive boulder, which is our freight variance, completely outweighs carrying a handful of tiny pebbles, like heating value or boil-off rate. Moving to Section 3, the minimum tradable edge.
This is where we set the mathematical boundary. So, knowing our total standard error across that entire stack is $0.1327 per MMBTU, we can draw a very strict line in the sand. This is the exact boundary where an opportunity stops being a real trade and basically becomes a coin toss with transaction costs. If we set our minimum edge at a conventional 3 standard errors, that requires a profit edge of exactly $1,491,911 US per standard cargo. Seriously, say that number out loud on your desk. Anything less than that, it should be declined on pure arithmetic before anyone even starts forming a view about the wider market.
But here's a really cool desk mechanic for you. Freight isn't just a cost to minimize. It's this massive source of variance. So if you fix the ship before committing to the trade, you completely remove that massive freight variance from the equation. The result? Your standard error drops, and your trading threshold lowers by 25.8%, bringing it down to $1.11 million. So fixing early can magically convert an untradeable opportunity into a highly tradable one.
All right, Section 4, Price Constraints versus Gates. This is our fork in the road.
Now, a minimum mathematical edge is definitely not the only reason we say no. In the real world, on a real desk, we have to split our reasons for declining into 2 totally different buckets. First, we have price constraints. That's stuff like your edge being inside the error bar, having no vessel available, or your credit being exhausted. These can theoretically be overcome if your edge is big enough. But then, we have regulatory gates, like origin verification and destination authorization. These are purely binary. You either can do the thing or you absolutely cannot. A gate simply does not have a price.
Let's jump to Section 5, EU versus US desk realities. The structural contrast here is so important.
The recurring theme we really need to internalize is the difference between permissions and demonstrations. It's a huge contrast. A US desk mostly operates on once-off permissions. For example, checking if a destination sits inside an export authorization held under Section 3 of the Natural Gas Act. You get the permission once and check it per transaction. But in a EU desk, they operate on demonstrations. Because of prior authorization regimes and strict sanctions packages, an EU desk actually has to explicitly verify and reproduce monitoring, reporting, and clearance for every single cargo, literally cargo by cargo.
And this brings us to a massively critical conduct lesson. Never, ever convert a regulatory gate into a timing question. Especially when you've got a vessel just sitting there racking up $90,000 an hour in demurrage decay. Those wait time penalties are brutal. The absolute most dangerous sentence you can hear on a desk is, "We're confident the origin is fine, we'll just confirm it after fixture." Look, having the facts right isn't the test. Being able to demonstrate those facts right at the moment of decision, that is the true test. The person holding the gate must never be the one feeling the financial pressure of that decay.
Moving to our final section, Section 6, Tracking Errors of Omission. Let's take a walk through the invisible graveyard.
Okay, so we know how to decline, but if a desk just declines everything, they've basically replaced human judgment with a rigid rule. So how do we actually prove that our discipline is working, especially since trades we don't take never show up in the P&L? The remedy costs absolutely nothing, but it's almost never done. You need to build a declined opportunity register right inside your ETRM system. You log the date, the counterparty, the computed edge, and the specific constraint. But here's the magic part. You fill in the realized outcome later based on what actually happened with observable prices. Give it a year, and this becomes the only undeniable proof you have to show if your threshold was actually calibrated correctly.
Let's look at a post-mortem case study to see what happens when you ignore these strict mathematical boundaries. A desk found a tight basin spread with a tiny 0.21 edge, which is just 1.58 standard errors. They decided to execute it 11 times, figuring that portfolio repetition would magically bring diversification. Well, instead, they lost $3.18 million over 2 quarters. Why did that happen? Because the freight market, the price assessments, and the seasonal berth congestion were practically identical across all 11 cargoes.
The ultimate takeaway here is that repeating a trade only reduces your variance if the errors are actually independent. When your trades share common assessments and freight conditions, repeating the trade just scales up your exposure. It's a trap. Therefore, your minimum edge threshold absolutely must apply to the correlated family of trades, not just individual tickets.
By combining an honest error stack with a rigid respect for regulatory gates, you totally transform the act of declining. It goes from feeling like a failure into a seriously powerful tool for your desk's survival. Next time, in Chapter 7, we'll be exploring the critical line between deliberate speculative positions and continuous flow business. But until then, I want to leave you with this. If your desk isn't actively tracking its omissions, just how much invisible money are you leaving on the table? Think about it. I'll see you in the next explainer.
Welcome back to the LNG Trading Desk Master Program. I'm your consultant from Durga Analytics. Now, drawing on my decades of experience doing exactly this, trading physical and financial LNG across the U.S. Gulf, Europe, and Asia, running those long-term SPAs, chartering vessels, and actually building these ETRM systems from scratch, today we are tearing down exactly how your desk misallocates risk controls between your flow and speculative businesses. We're currently in Module 1, Chapter 7 of our 120-chapter sequence journey, where we cover literally everything from market structure and senior playbooks right through to desk leadership. Today, we're looking at two entirely different businesses living inside a single desk, with two entirely different loss profiles, and the dangerous, almost backwards way we tend to control them.
Let's just quickly scan our agenda for this explainer. We're stepping from the first principles of obligation right through to the hard operational realities on both sides of the Atlantic. We'll redefine risk, measure that control inversion, look at how the losses diverge, contrast our US and EU desks, dig into exposure by subtraction, and then we'll wrap up with a real-world case study.
Okay, Section 1, Obligation over Intent. Let's look at how we actually define desk risk.
We absolutely have to start by fundamentally rewiring how you define risk on your desk. Seriously, if you ask a desk to separate its speculative business from its flow business, they almost always separate it by intent. You know, the trades we did to make money versus the trades we had to do. But honestly, that definition fails immediately. We have to move away from intent and focus on where the obligation actually originates. So your workable definition is this. Flow business is what you are committed to by a pre-existing arrangement, like a term SPA or a booked regas slot. In flow, your job is simply to execute well. Speculative exposure, on the other hand, is a current decision. It's an active choice to add or retain risk when you literally could have chosen otherwise. In the speculative book, your job is to be right. This matters because intent leaves absolutely no audit trail. Obligations do.
Right, Section 2. The controlled density inversion, or how we actually measure these risk controls. Let's look at the visual arithmetic of how these two halves of your desk are measured and controlled, because this is where we really start to see the cracks in traditional desk governance. If we break down a typical portfolio desk, say running 20 term cargoes and 4 discretionary ones, the first 3 measurements here make perfect sense. Flow holds roughly 83% of the volume, 43% of the result, and 36% of the expected loss. Speculative handles the rest. No surprises there, right? But look at that 4th measurement. The flow book only gets 20% of the control spend, while 80% goes straight to the speculative book. That 4th column, that is a choice. And it entirely ignores the mathematical reality of your expected losses.
And this brilliantly illustrates the paradox. If you take a standard risk control budget and apply it per dollar of expected loss, your speculative book is 2.2 times more densely controlled than your flow book. Think about that multiple for a second. You were spending 83 cents on control for every single expected speculative loss dollar and only 37 cents for flow. Now, I'm not saying the allocation needs to be exactly 1-to-1 because speculative tails are incredibly dangerous. But on most desks, this massive imbalance is just an inherited habit. It's not a deliberate costed decision.
Section 3 now, diverging loss profiles, frequent versus rare losses.
The reason this mismatch is so dangerous is because these two halves have entirely different loss shapes, meaning they require completely different controls. You simply cannot govern them with the same philosophy. Notice the shape of these distributions here on a logarithmic scale. Speculative losses, they're rare, but they are massive. A wrong market view, a busted hedge, a bad destination. Flow losses, however, are frequent but small. We're talking about demurrage, measurement discrepancies, minor nomination errors. They fly totally under the radar and create the slow, bleeding accumulation of losses that nobody on the desk actually owns.
Because the loss profiles are different, the tools absolutely have to be different. Applying a speculative limit to flow risk, it just fails because flow losses are individually way too small to ever trigger that limit. And conversely, applying a checklist to speculative risk, that just produces a false sense of assurance on what is ultimately just a bad judgment call. A checklist isn't going to save you from a wrong market view, and a limit will never stop you from bleeding out 50 grand into merge across 20 different cargoes.
Now, if we map this onto the physical reality of the value chain, speculative risk concentrates entirely at the front of the cargo's life. It peaks right at the deal, when you decide the size and the hedge, and then it sharply declines. Flow risk is the exact opposite. It starts low and rises exponentially at the back end, peaking through nomination, loading, discharge, and settlement. This tells us that the folks running the front of the cargo need limits and decision rights, while the operations and scheduling teams at the back end need strict checklists and reconciliations.
Moving on to Section 4, U.S. versus EU desk operations. Let's talk regional differences.
We really need to ground this abstract concept of flow risk into the concrete operational realities of your specific desk. As a professional trying to run a desk that actually survives and makes money, you have to understand that these two geographies answer to different regulators, and honestly, they fail in completely different ways. The structural contrast you need to remember is how flow risk manifests at the back end. A U.S. desk mostly acquires permissions. You check permissions once per transaction, like an export license, and that's your core flow control. But an EU desk? An EU desk must reproduce complex demonstrations for every single cargo. We're talking proving emissions compliance, carbon tracking, strict origin documentation every time a vessel arrives. If you try to apply a US-style check-it-once permission check to an EU desk's demonstration obligations, your flow leakage is going to absolutely skyrocket because the regulatory friction is just exponentially higher.
All right, Section 5, Exposure by Subtraction, or how to create risk completely invisibly. Let's see how this builds into the absolute hardest case and honestly the trap that defeats almost every ETRM system design out there. A single cargo changing categories mid-voyage. Follow the life cycle of this one cargo with me. Step 1, it starts as flow, a term SPL lifting. Step 2, it gets sold forward at index, still flow. But in Step 3, the trader forms a market view and lifts the index hedge. Boom, it's now entirely speculative. Step 4, the cargo is diverted to a different basin entirely, adding a second dimension of speculative risk. Finally, in Step 5, the market normalizes and it's delivered on the original term sale, reverting right back to flow. Now the crucial point here, the thing that keeps risk managers awake at night, is that because no new trade was executed to lift that hedge, it was exposure by subtraction. There is literally no new ticket in your ETRM. The control set completely fails to catch the two category changes right in the middle of this cargo's life cycle. This is a big deal, because a massive speculative position was opened purely by the removal of a hedge, bypassing standard approvals completely unnoticed. So, when the dust settles, what exactly will your risk committee see? Well, if your attribution is built on the instrument rather than the obligation, the record simply shows a term cargo lifted under an SPA and delivered against a term sale. It entirely blinds you to the massive speculative exposure carried in the middle of the voyage. If the outcome was profitable, people falsely attribute it to good execution. If it lost money, it gets falsely blamed on the market. Neither reflects reality, and both are incredibly dangerous habits for a trading desk to form.
Which leads us to Section 6. Let's look at a case study, the unreviewed flow book.
Let's pull this all together with a real
3-year desk case study that perfectly proves why traditional materiality thresholds are a massive defect when applied to flow business. Just look at the arithmetic here. Over 3 years, the speculative book had 2 massive, highly scrutinized losses totaling $3.1 million. Both were reported to the risk committee instantly, but look at the flow book. It bled out $3.57 million net across 94 completely unreviewed events. Not a single one of those 94 events was large enough to trigger a reporting threshold, so the desk thought the flow book was low risk, while in reality it was bleeding more money than the speculative book.
That aggregate leakage just had no owner. Sure, operations knew about the individual demurrage claims, but because every control was designed around single event materiality, nobody bothered to add the numbers up. The remedy here is actually incredibly simple. It requires absolutely zero IT system changes, and you really must adopt it. You have to require a single unthresholded monthly number of total flowbook leakage, gross and net of recoveries, and you put that number right next to the speculative losses on your risk report.
And that brings us to a pretty provocative final thought for this explainer. If invisible, unthresholded flow leakage is what slowly drains your desk day by day, what happens when the speculative tail actually breaks the chain of survival? Well, in Chapter 8, we are going to take that speculative tail very seriously, and we'll map out exactly how LNG desks actually fail. I'll see you in the next chapter.
Hello and welcome back to the LNG Trading Desk Master Program. I'm your host, an LNG trading and risk management consultant from Durga Analytics. You know, over my decades in this industry, trading physical and financial LNG out of the U.S. Gulf, moving it into Europe and Northeast Asia, negotiating those massive long-term SPAs, chartering vessels, and actually building ETRM systems and trading desks from the ground up, I've seen a lot. This program is our sequence journey across 9 modules and 120 chapters, taking us all the way from the sheer physics of the value chain right up to desk leadership. Today, we are wrapping up Module 1, and we're diving into Chapter 8, How LNG Desks Actually Fail. We are going to strip away all those standard postmortem excuses and look at the hard, verified arithmetic of why desks really collapse.
Okay, real quick, here's our roadmap for this explainer. First, the anatomy of failure. Then, we'll walk through a U.S. desk case study on incomplete decomposition, followed by an EU desk looking at unexercisable optionality. After that, we'll look at why VAR completely missed it, run through the 6 ways desks fail, and finish up with the near-miss register. Let's get to it.
Section 1. The Anatomy of Failure.
So whenever I'm brought in to investigate a desk collapse, the team almost always points to a single massive event, right? They'll say, well, the plant failed, or the market just moved completely against us, or the ship was late. But listen, events are just where the money is actually lost. They're not where the failure occurred. Failures are chains. They always start with some calm, cheap, seemingly minor decision made months earlier that quietly creates a huge vulnerability. To fix this on your desk, we have to completely reframe that traditional post-mortem mindset. We need to stop asking what went wrong, because honestly, that just points you right back to the final event. Instead, ask yourself this highly specific diagnostic question. What would have had to be true for this event to cost us absolutely nothing? The answer to that question? That names your exact broken link. Section 2. U.S. Desk. Incomplete decomposition. All right, let's dive into a practical application. Now, remember our core geographical rule for this entire course. A U.S. desk mostly acquires contractual permissions. You obtain them once, and you check them per transaction. That structural reality dictates exactly how they fail. So let's look at this failure chain for a nearly $21 million loss on a U.S. desk. Link 1, the desk signs a sale, but they don't get a matching relief clause. Link 2, the exposure is recorded just as price risk. It's never actually decomposed into volume and delivery. Link 3, the event happens. The plant declares force majeure. Link 4, panic sets in as the desk suddenly realizes their hedge only covered the price, not the delivery. Link 5, They are forced to go out and buy replacement volume under highly visible market distress. And finally, link 6, that $20.9 million loss firmly crystallizes. Now check out the math plotted here on a log scale. This shows the cost of intervening at each of those distinct links. Now, standard postmortems, they almost always blame link 1, the contract. But you and I know that getting a relief clause from a counterparty in the real world is hard, expensive, and sometimes it's literally impossible. The absolute cheapest intervention wasn't negotiating the contract at all. It was link 2. Decomposing that exposure into price, volume, and delivery, that would have taken one of your analysts maybe a week. Let's price that at about $15,000. And the best part? That requires absolutely no counterparty, no tough negotiation, and zero permission. That 1399x multiplier right there, that brilliantly illustrates the sheer asymmetry of failure, because they ignored that simple $15,000 analytical step at link 2. They allowed a $20.9 million loss to crystallize. That realized loss was exactly 1,399 times more expensive than just doing the cheapest upfront intervention. Section 3. EU Desk. Unexercisable optionality. As you know, every single chapter in this program carries both a US and an EU case study. And we do this because they answer to totally different regulators, they hold completely different infrastructure commitments, and they fail in structurally different ways. So while our US desk was all about acquiring contractual permissions, an EU desk acquires physical demonstrations. An EU desk has to actively reproduce its physical capability for every single cargo. And let me tell you, when they forget that physical reality, the losses are absolutely staggering. Here is a real EU desk's failure chain. They were holding an oil-indexed position with destination flexibility for a big 20-cargo annual program. Link 1, they didn't negotiate a price review clause. Link 2, that destination flexibility, it was never actually tested against real fleet availability. Link 3, crude rallies hard, but European gas just doesn't. Link 4, they desperately try to divert the cargoes to Asia to capture the value, but guess what? The physical route proves utterly unavailable for the program. Link 5, they are forced to discharge into Europe at a massive loss, which leads to Link 6, a catastrophic $103.7 million loss across those 20 cargoes. Let's run the intervention math on this one. The total swing value between the Asian and European outcomes across that entire program was over $169 million. But intervening way back at Link 2, just conducting a straightforward fleet availability study to see if their ships could actually physically make that Asian voyage, would have cost them roughly $40,000. That is an astronomical 4,229 to 1 return on investment. The desk treated their destination flexibility like it was a pure financial option. But the crucial takeaway here is this: a right that you cannot physically exercise is simply not an option. When you put both of these chains side by side, the structural pattern is totally undeniable. We're looking at two different desks, two different geographies, two completely different types of trades, yet in both scenarios, the first two links are cheap. They are completely invisible and they are purely analytical. The final links, where the money literally vanishes, are expensive, they are highly visible, and they are deeply physical. Section 4. Why VAR missed it. Now, any competent risk committee is going to look at this and ask, why on earth didn't our modern multi-million-dollar risk systems sound the alarm on either of these desk-ending losses? Look closely at this comparison. The EU desk's reported value at risk was just $12 million, yet the chain lost $103.7 million. That is 8.65 times the reported VAR. But here is the kicker. On the morning of these events, neither book breached a single limit. The risk system reported both books as perfectly unremarkable. And honestly, the really uncomfortable truth here is that the system was actually correct to do so. Whenever I audit ETRM systems, I always have to remind the trading teams, VAR didn't fail you. It just wasn't measuring the things that actually kill LNG desks.
VAR does a fantastic job of measuring the distribution of price moves and historical volatility on marked positions. But what actually ended these two desks? Counterparty legal excuses and unexcisable physical shipping rights. VAR is completely 100% blind to physical shipping constraints and contractual asymmetry. You absolutely have to have non-model measures as a backup. Things like the hard cost to reach flat and a rigorous, itemized list of exposures for which no financial instrument even exists. Section 5. 6 Ways Desks Fail. So, stepping back, these are the 6 recurrent ways LNG desks actually fail in the real world, ranked by frequency. Take a close look at what is conspicuously missing from this list. You don't see bad forecast, you don't see rogue trader, and there's no massive fraud. Sure, those things happen, but they are incredibly rare. Desks actually bleed out from systemic structural issues. Number 1, incomplete decomposition of risk. 2, unexercisable optionality. 3, asymmetric relief clauses. 4, speculative exposure created by subtracting hedges. 5, aggregated operational leakage. And 6, drift up the obligation ladder. Every single one of these is completely invisible to your standard MMBTU control limits. Section 6, the near-miss register. So the million-dollar question, how do you manage what your expensive risk system literally cannot see? We're going to transition now to the definitive desk leadership solution. The fundamental problem with trying to learn from realized post-mortem failures is that they are just too rare. Plus, by the time they actually happen, the folks who made those crucial early decisions are usually long gone. You need data on the chains that stopped. That is what a near-miss register is for. It formally records exactly where a failure chain was caught, who caught it, and critically, what it would have cost the desk if it had run to the very end. Make no mistake, this is your only reliable source of data for the links that actually matter. And you track this religiously because prevention absolutely dominates detection. If we jump back to our US chain for a second, detecting the problem late at link 4 cost them over $10 million. But preventing it early at link 2 would have only cost $15,000. Relying on late-stage detection is roughly 699 times more expensive than just doing the upfront analytical prevention. Yet time and time again, desks underinvest in analysis because it's invisible, whereas a daily risk report is highly visible to the board. When desks first roll out this register, they invariably stumble into a deeply uncomfortable statistic. The vast majority of their near misses are not caught by those expensive automated controls firing. They are caught by a specific human being who just happened to notice that something looked a little off. Which brings us to a crucial, hard evaluation for your own desks right now. If your near misses are primarily being caught by human intuition, it means your true detection capability isn't documented anywhere in your ETRM system. You have to ask yourself honestly, are your desk's single points of failure actually robust documented controls, or are they just specific people? And that wraps up Module 1. But I want to leave you with this final, somewhat provocative thought to take back to your own operations. If the undocumented knowledge of those specific people walks out the door every single evening at 5 p.m., are you sitting on a failure chain that is already halfway built? Think deeply about that. All right, having mastered desk accountability and the mechanics of failure, we are ready to move forward. Up next is Module 2, LNG market structure that actually matters. I'll see you there.
Welcome back to the LNG Trading Desk Master Program. Just a quick reminder right at the top, this is our sequence journey across 9 modules and 120 chapters, taking you from the very basics of desk accountability all the way through to desk leadership and legacy. Today, speaking as your Durga Analytics consultant, we are in Module 1, Chapter 9, and we're going to completely dismantle your assumptions about governance and escalation.
Look, I've spent decades building, running, and fixing physical and financial LNG desks, from the US Gulf all the way to Europe and Northeast Asia, and I can tell you this for a fact. The governance frameworks sitting on most of your desks right now, they're perfectly designed to produce a beautiful paper trail, but they do absolutely nothing to protect your capital. Today, we're going to fix that.
Here is our roadmap for today's explainer, starting with the illusion of escalation, moving through triggers and authority, unpacking the true cost of overrides, contrasting our US and EU desks, and wrapping up with a real-world case study.
All right, let's dive right into Section 1, the illusion of escalation.
Let's be brutally honest for a second. Most escalation procedures sitting on your desks right now are actually just notification procedures in disguise. And in a highly volatile LNG market, that tiny semantic difference, it can literally destroy a desk. There's a fundamental test you need to apply to your own policy today. Go read your procedure and ask yourself, after this specific step is taken, who actually has the power to commit the desk? If the exact same trader still gets to decide whether to hold or fold the position, you haven't escalated anything. You've only moved information. You've just notified someone. True escalation means authority moves, and a completely different person is now making the call. If the authority doesn't move, you won't stop a chain of failures, because the person who dug the hole is still the one deciding if they should keep digging.
Moving on to Section 2, why your triggers absolutely must be prices. You know those risk limits you have that are expressed in mark-to-market losses? They are fundamentally broken. Why? Because quite frankly, nobody is watching them in real time on a busy desk. We have to shift our language. Discretionary wording like escalate if the position becomes concerning is terrible. It never fires. It relies entirely on a trader's subjective judgment at the exact moment they have the absolute least appetite to judge the situation objectively. Instead, we have to shift to conditional wording. Escalate when TTF prints below 9.1329. That fires on a cold, hard, observable screen price. It fires identically for everyone. Invoking it isn't some embarrassing admission of defeat. It's just a market fact.
So how do we actually get that exact trigger price? The arithmetic takes, 10 minutes? Let's say you've got 6 live standard cargoes entered against TTF at $9.80. That delivered volume is about 22.4 million MMBTU. If your notification threshold is a $9 million mark-to-market loss, you simply divide that loss limit by your volume. That gives us an adverse move of about 40 cents. Subtract that from your entry price, and boom, your $9 million hidden loss threshold is now a highly visible TTF trigger price of 9.3997. By converting your whole escalation ladder this way, the desk shifts from relying on a control that only fires when a mid-office accounting report is cranked out at the end of the day to a control that fires exactly when the market prints on a screen everyone is already staring at. Think about it. A trader can easily hold 3 trigger prices in their head while they're working. Nobody, and I mean nobody, is holding a complex dynamic mark-to-market threshold in their head while actively trading.
Okay, Section 3, moving the authority.
The absolutely crucial point we're building toward here is what happens when that market really turns against you. As the escalation ladder is climbed, the authority to act must explicitly leave the person who built the position, tracing this outward movement. At the notification level, sure, the trader still holds the pen, but risk is formally informed. At the escalation level, the desk head takes over, but at the ultimate reduction level, the decision to realize a massive loss absolutely cannot sit with the trader whose initial thesis was wrong. Why? Because as we'll get into later in the behavioral modules, traders will always find a reason to hold on. My thesis is intact, or we just need to average down. The rationalizations are endless regardless of the facts, making the trader structurally unsuited to make this specific call.
Furthermore, when that authority finally reaches the risk committee, your policy must specify a pre-agreed minimum fraction of the position to cut. If the rule just vaguely says reduce exposure, the desk is going to execute a tiny token reduction just to satisfy the letter of the instruction. And what happens next?
The trigger just fires again tomorrow, leading to the exact same exhausting debate. Pre-agree the minimum, say 30%, and you convert a messy negotiation into a direct clinical instruction.
Section 4. Let's talk about the silent killer of trading desks, overrides.
Almost every desk tracks the mere count of overrides granted, and I'm going to show you exactly why that is a massive governance failure. Your management committee might look at a monthly report and notice your override count grew from 3 to 27 over a year. Okay, an 800% growth. They might ask a few questions, but they are completely missing a staggering 133-fold explosion in your actual financial exposure.
How does that even happen? The multiplier concealing this massive existential risk is duration. An override without a short, mandatory expiry date just stays open forever. It becomes a permanent hole in your control framework. Imagine the median duration of an override creeping up from 5 days to 74 days, silently stacking up thousands of override days outstanding. That is the variable you actually need to be measuring. The rule that prevents all of this from spiraling out of control is simple. Demand a hard expiry date. And I mean an expiry date, not a review date. Because honestly, nobody attends review meetings. We want an expiry where the control strictly and automatically reasserts itself. And here is a golden rule to pass on to your risk teams. An override that gets renewed 3 times isn't an exception anymore. It's a loud flashing signal that your limit framework is calibrated for a business you don't even run anymore, and the limit itself needs to be changed through proper governance.
Section 5. Now we have to look at this through our dual desk lens.
Because our US desk and our EU desk answer to entirely different regulators, they fail in completely different ways, and your governance structure has to reflect that reality. Structurally, remember that the US desk operates on one-time gate permissions. Think of Section 3 Natural Gas Act export authorizations. A gate has absolutely no cost to accept, so it is never overridable. You simply cannot grant an override for an unapproved destination. End of story. The EU desk, on the other hand, must continually reproduce verified demonstrations for every single cargo. Think about verifying the country of production under strict sanctions regimes. Plus, your escalation procedures have to be hyper-aware of their regulatory reach. A U.S. position might span both CFTC and FERC anti-manipulation boundaries, while an EU desk's escalation instantly reaches outside the desk if it even touches a benchmark or triggers a remit disclosure obligation.
Finally, Section 6. Let's put this all together with a case study, the broken ladder.
Let's validate this machinery. This is a composite of real-world patterns where a desk followed a highly praised, freshly audited, properly documented escalation process perfectly, and yet they still suffered a devastating financial blow. Over 14 trading sessions, a position of 6 cargoes just went totally bad. Notice how every single trigger fired right on time at the correct TTF price. The paper trail? Flawless. Yet, structural design defects turned a supposedly functioning ladder into a $41.3 million realized loss. Let's look closely at exactly where it broke.
All right, first, the levels at Session 3 and Session 6 moved information, sure, but they left the actual authority sitting right there with the trader. So, surprise, surprise, nothing actually changed. Then at Session 9, we hit the big reduction level. But wait, the risk committee had a quorum requirement. Key people were traveling, the quorum wasn't met, and that completely avoidable delay cost over $7 million of adverse market movement by the time they finally met in Session 11. And when they finally did convene, they executed a tiny 20% token reduction, leaving a massive 80% of the exposure sitting right out there in the path of a dropping market.
The remedy here is so simple. It requires no expensive ETRM system rebuilds. It literally just requires one-sentence amendments to your existing policy. Explicitly move the authority at every single level. Replace those dangerous quorums with standing rotas and named deputies so the mechanism physically cannot fail to convene. And finally, define a strict minimum reduction size in advance.
As we close out this explainer, I have a challenge for you. Go back to your desk today, pull out your escalation policy, and honestly evaluate what is actually escalation and what is just notification. But more importantly, ask your risk function for your override days outstanding. If they can only give you a count, that is your first major red flag. And when that override days number finally arrives on your desk, I guarantee you, the explosion in your hidden exposure is going to shock you.
Next time, in Chapter 10, we'll be transitioning from what the desk decides to what the desk actually reports. We'll be breaking down exactly why the accounting P&L and the economic P&L constantly diverge. If you're sitting there thinking your desk is fully hedged, ask yourself this: what exactly is hiding in your unexplained residual? We'll find out next time.
Okay, let's get right into this explainer. I'm bringing my decades of experience from Durga Analytics to walk you through this one, and it's a critical topic. Just as a quick reminder, this is all part of our LNG Trading Desk Master Program. It's a sequenced journey across 9 modules and 120 chapters. We cover everything from desk accountability and market structure, right through senior playbooks, valuation and risk, all the way to shipping, ETRM systems, regulation, and desk leadership. Right now, we're in Module 1, running an LNG trading desk, and specifically, we're tackling Chapter 10, the senior view of LNG desk P&L. Today, we're establishing a central, frankly uncomfortable conflict. The single P&L number a desk head is handed is basically lying to them. It blends different realities together, it hides fatal risks, and it drives some of the absolute most dangerous commercial behaviors you're going to see in the market.
So here's our roadmap for deconstructing that illusion today. We'll start with a single number illusion. Look at the 3 questions hidden inside it, trace how we attribute a cargo's result, expose the unexplained residual, look at P&L divergences across desks, and finally land on the true senior view.
All right, kicking things off with sections 1 and 2. The single number illusion and 3 questions, 1 number.
We really need to understand up front that a single P&L figure is essentially blending entirely different realities, and crazy enough, they can point in opposite directions at the exact same time. The crucial point here is distinguishing between these realities. On one hand, you have the marked economic result across all your legs. And yeah, that includes the unsettled ones. This tells you if your chosen positions actually made money in the real world. But, this is often completely ignored because it doesn't cleanly tie back to the ledger. On the other hand, you have the accounting result. This is what the firm is actually going to report. And this number is heavily managed because, well, let's be honest, it's the number people get paid on. But here is the really dangerous part. A single blended number completely omits a third massive question: liquidity adequacy. Can we actually fund what we hold through the absolute worst path to settlement? Cash and margin projections aren't technically P&L, which means liquidity is totally absent from the report, right up until the exact day it becomes the literally only question that matters to your survival.
And this brings us to a structural contrast we talk about constantly in this program. A U.S. desk is mostly out there acquiring permissions. Think of things like fixed liquefaction tolling fees. You get them once, and they create immense accounting and sunk cost pressures. An EU desk, however, is a whole different beast. They mostly acquire demonstrations. They have to reproduce per cargo compliance, emissions reporting, terminal nominations, over and over again. And that triggers relentless, continuous liquidity crunches and working capital pressures. They fail in completely different ways, and blending their numbers just obscures exactly how that failure is going to happen. Moving right along to Section 3, Attributing a Cargo's Result.
Let's actually break down how a number gets onto that report in the first place. And let's trace it from the initial commercial trade straight down to the residual. Walk through this with me because, frankly, a shocking number of desks have never actually traced a single cargo end-to-end. We start with the commercial trade, say an FOB purchase out of the US Gulf and a DES sale in Europe against TTF. Next, the ETRM position. It's not just one neat number, it is asymmetric legs. You've got feed gas exposure against sale exposure. Then comes valuation, where both legs are marked at the delivered curve. Fourth step is attribution, which decomposes this movement into specific drivers, things like feed gas, basin TTF, freight, and boil-off. And finally, whatever is left over, that's your residual. It's left over simply because it belongs to none of those 4 drivers. Now hear me on this. That is a statement about your attribution model, not a statement about the market.
If we compare a U.S. desk cargo against its plan, we might see a planned margin of, say, $10.5 million, but an actual realized margin of $12.18 million. Awesome, right? That's a variance of over $1.65 million favorable. But a senior reviewer who stops there and just pats the trader on the back has learned absolutely nothing. While drivers like feed gas, basin, freight, and boil-off explain about 1.5 million of that movement, the senior eye needs to lock onto that little blue bar immediately. That is a $151,352 residual that literally nobody can explain. It survived every single level above it.
That takes us to Section 4, exposing the residual.
So how exactly do we handle that unexplained blue bar? The absolute ironclad rule here is you measure it against the gross attributed movement, not the net variance. Think about it. In our example, the net variance was about 1.65 million, which makes the residual roughly 9%. But what if a massive favorable feed gas move perfectly offset a massive adverse basin move? The net variance would collapse to near zero. If you divide your residual by near zero, the ratio explodes to hundreds of percent, and you're falsely triggering a total catastrophe alert out of pure, dumb arithmetic. By using the absolute value gross denominator, which in our case was actually 1.71 million, you get a stable, honest metric.
Now, looking at just one cargo's residual isn't going to cut it. When you're reviewing a full 12 months of residuals, the actual size of the residual is far less important than its direction. Why? Because genuine random measurement noise is basically like flipping a fair coin. It has absolutely no preferred direction. But if you look at these 12 months, notice how 11 out of 12 share a positive sign? Yeah, random noise simply doesn't do that.
The math behind this is your ultimate early warning system. Finding 11 out of 12 residuals sharing a sign gives us a two-sided tail probability of 0.0063. To put that into perspective, that is 0.6%. This blares an alarm that what you were looking at is not just noise. It is a fundamental, systematic attribution defect. Just a quick heads up on the math here, because I see this error all the time on trading desks. Never, ever calculate the point probability of exactly 11. A true inferential p-value test has to include results at least as extreme as the one you observed. That means the 12 of 12 scenario must be included in your calculation. If you just calculate for exactly 11, you're relying on the wrong math. It might round to a similar number this time, but trust me, it will fail you spectacularly on a different count. Let me ground this in a real-world composite case study. We had a desk that saw this exact pattern, 11 of 12 positive residuals averaging 151K per cargo. That created $1.8 million a year just flowing through the desk with no owner. And you know what? The desk completely ignored it because it was favorable. They just assumed it was some conservative upstream estimation. It wasn't. Actually, it was a heating value convention mismatch. The purchase priced on a gross heating value at loading, the sale priced at discharge, but the attribution model used loading for both. It happened to be favorable on this specific route, but on the reverse route they were literally just about to open, it would have been a lethal, unmodeled bias. The real beauty of the sign test is it requires zero model calibration, just pluses and minuses, and it would have flagged this systematic error in just 6 months.
All right, Section 5, P&L divergences and desks. This is where we examine exactly where economic and accounting realities violently diverge in LNG. And this divergence forces desks into some very, very dangerous behaviors. Every single row here represents a place where a desk head managing the reported accounting number is going to make a completely different decision than one managing the true economic reality. For instance, a cargo at sea is marked economically continuously. But accounting, they might unrecognize it entirely until discharge. That makes the desk look flat while they're actually holding massive market exposure.
And for a tiny bit of irony, consider the tolling fixed fee for a U.S. desk. Economically, it's a sunk cost. It should have absolutely zero bearing on a lifting decision, but under accounting, it's treated as a period expense. Traders and accountants rarely see eye to eye, but here it really matters. This creates immense, totally artificial accounting pressure to lift uneconomic cargoes just to absorb that fee. It's a classic error that arrives straight through the accounting system rather than from a modeling mistake.
And finally, Section 6, the true senior view.
So, armed with all this structural skepticism, how do we stop just passively reading the ledger? A rigorous desk head has to ask these 6 precise questions. We've already covered the gross residual and the sources, but look closely at number 4. Did a cargo change category between flow and speculative? If a term cargo's index hedge is lifted mid-voyage, a positive basin spread result looks like incredibly skilled flow execution on paper, but it's actually an unrecorded speculative gamble. And crucially, look at number 5. What is the cash position at the absolute worst path to settlement? A period-end report entirely hides the days mid-month, where aggressive margin calls can outright kill the desk.
I want to leave you with that provocative thought. If you are managing your desk by period-end snapshots, do you actually know your cash low point? In LNG, that critical low point is typically weeks before period end. Understanding exactly how these reporting blind spots propagate downwards perfectly sets up our transition into Chapter 1, where we are going to examine ETRM systems not just as pieces of software, but as the critical, life-saving control architecture for your entire desk. See you in the next explainer.
Hey everyone, and welcome back to The Explainer. I'm an LNG trading and risk management consultant from Durga Analytics, and today we're stepping right onto the trading floor. This is all part of our LNG Trading Desk Master Program, which, as you know, is our sequence journey across 9 modules and 120 chapters, covering the whole shebang, from market structure and contracts all the way to execution, risk, and leadership. Right now, we are in Module 1, Chapter 11, focusing on ETRM systems. And today, we are going to figure out exactly why a single, simple, missing data field can cause a massive $1.26 million settlement break on your desk.
We've got a packed agenda today. We'll quickly cover the program context, dive into control architecture, look at the 3 measured quantities, break down that crucial US versus EU desk contrast, explore downward propagation, and finish up by decoding shadow systems. All right, starting right off with Section 1, our master program context, currently in Module 1, Chapter 11. Moving into Section 2, control architecture. And the key takeaway here is that it's absolutely not just software. The biggest myth we really need to bust right out of the gate is treating an ETRM as just some vendor software product you install. What a functional LNG desk actually relies on is a rigorous, layered control architecture. Just look at how it's mapped out. We have 6 essential layers, working from deal capture all the way down to settlement. Every single layer answers exactly one question, and it depends entirely on the answers handed down from above. So calculation flows down, but check out the flow of information. Error detection actually flows up. Settlement breaks reveal capture errors. Risk reconciliation exposes reference data problems. The golden rule of desk governance here is that a defect detected downstream has to be corrected at its originating layer. You never, ever just patch it where it surfaced. Let's jump to Section 3, the 3 measured quantities, basically the anatomy of a break. So every layer in that architecture might be doing exactly what it was configured to do. But here's the catch. These systems were mostly built for legacy pipeline gas, where gas entering a pipe basically just arrives at the other end. LNG physical measurement is a whole different beast. A single LNG cargo actually has 3 distinct measured quantities: nominated, bill of lading at the loading flange, and discharged at the receiving terminal. Yet, most of these legacy systems are configured to hold only one volume field. So you've got a cargo with 3 volumes and a system with exactly 1 box to put them in. To put that into perspective,
Let's look at the financial math. Let's say your nominated volume is 3,880,200 MMBTU. The bill of lading is slightly less, and the discharged quantity drops down to 3,747,579. That difference between the bill of lading and discharged quantities is 128,921 MMBTU. If we price that at, say, $9.80, you're looking at a $1.26 million gap per cargo. And the crazy part? This isn't a surprise loss, it's just the natural boil-off and heal that the desk already knows about. But in a single-field system, that gap simply isn't represented anywhere. So it shows up as this massive settlement break that literally has to be manually papered over as a reconciliation adjustment for every single cargo, forever. Which brings us to Section 4, the U.S. versus EU desk contrast, permissions versus demonstrations. Now, how does this structural flaw actually play out in the real world? Well, it depends entirely on which side of the Atlantic your desk sits, because they fail in totally different ways. A U.S. desk typically buys free on board, or FOB. Their whole structural focus is acquiring permissions. You obtain them once, you check them per transaction. They care about that loading flange, and they pay on the bill of lading. On the flip side, an EU desk typically sells delivered ex ship, or DES. They acquire demonstrations. This means they have to constantly reproduce proof of delivery at receiving terminals for every single cargo, and they get paid on the discharged quantity. So think about it. If your desk buys FOB and sells DES, you're paying on the bill of lading and getting paid on the discharged volume. If your system only holds one volume field, you are structurally guaranteed to break your settlement layer. All right, Section 5, downward propagation. Let's talk about the real cost of fixing these errors. Let's see how this compounds when an error cascades through a desk. Remember, a defect at any layer propagates downward. Let's say you capture a cargo with just a single volume field. Maybe you just use the loaded quantity. Your position layer then records the purchase and sale as identical. Your book shows completely flat. Next, the valuation engine computes the mark on that flat position. Then your risk report calculates value at risk on that flat position, showing near zero. Everything looks fine. It isn't until weeks later, at settlement, when the FOB purchase invoice and the DES sale invoice simply don't match, that the error finally rears its head. The system didn't calculate anything wrong, folks. It was just asked the wrong question right at deal capture. And this graph shows the true cost of those cascading errors. It depends entirely on where you finally discover them. If you spot a defect at deal capture, you just amend a field before anything relies on it. It takes, maybe an hour? If you find it at valuation, now you have to restate a mark and explain a P&L move to management. That's about 15 hours of work. But if you don't catch it until a settlement dispute, you're looking at 260 hours. Why? Because you are now in a full-blown commercial negotiation. The plant, a ship owner, a terminal, a buyer, and some counterparty's finance team have all already acted on that bad data. That is a brutal 260 to 1 capture to dispute ratio, and it mathematically proves that the absolute cheapest control you can implement on an LNG desk is a mandatory field validation right at deal capture. And I don't mean a human review. I mean a hard system rule that literally refuses to save a trade unless the correct invoicing basis and heating values are stated. Finally, Section 6, decoding shadow systems, seeing them as evidence, not misbehavior. Because ETRMs have these massive architectural gaps, like holding one volume instead of 3, trading desks inevitably build spreadsheets just to survive the day-to-day. The standard corporate response is to launch some doomed crusade to eliminate all spreadsheets. But they exist for a reason. As this quote brilliantly captures, a shadow system is a precise map of the gap between what the desk needs and what the architecture actually supplies. That cargo tracker you have in Excel, it exists because the scheduling and position layers in your ETRM aren't talking to each other. Don't ban them. Recognize that these spreadsheets are highly accurate requirements documents, written by the exact professionals feeling the operational pain. You can actually diagnose your desk's health using this quick spreadsheet test. Just ask one question: what is the spreadsheet doing? If it holds data the system lacks, you have a system problem. You need to change your ETRM model. If it performs a calculation the system can't do, well, you have a process problem. Version it and assign an owner. But if a spreadsheet merely duplicates calculations the system already does, wow, you have a severe trust problem. That means someone with commercial responsibility simply does not believe the firm's externally reported numbers, and that requires your immediate attention. So I want you to really think about that question as we wrap up Chapter 11. Is your ETRM controlling your desk, or is your desk just spending its days patching your ETRM? Tracking the count of these shadow systems over time is incredibly revealing. In fact, next up in Chapter 12, we're going to look at how an increasing count of those shadow systems acts as a major leading indicator of desk decay, right before we dive into desk leadership and legacy to completely close out Module 1. Thanks for hanging out with me today, and I'll see you in the next explainer.
Hey everyone, and welcome back to this explainer. I'm your Durga Analytics consultant, and today is a big one. We are hitting the capstone of our sequence journey in the LNG Trading Desk Master Program. As you know, this program is a massive 120-chapter journey across 9 modules. We go from the absolute basics of desk accountability here in Module 1, right through market structure in Module 2, senior playbooks, valuation, risk, execution, ETRM systems, regulation, all the way to desk leadership and legacy in Module 9. Today, we're officially wrapping up Module 1, running an LNG trading desk with Chapter 12, Lessons from Failed Desks. Over the last 11 chapters, we've built a rock-solid foundation, covering everything from contracts to ETRM systems. But today we're looking at exactly how that foundation silently cracks.
Look, I've spent decades doing this. I've traded physical and financial LNG out of the U.S. Gulf and into Europe and Northeast Asia. I've negotiated long-term SPAs, charted the vessels, designed the ETRM systems, the whole shebang. So my goal today is absolutely not to bore you with academic theory. We're going to dive into actionable, desk-ready insights. We need to learn how to spot the silent symptoms of a failing desk, specifically when reported profits are still hitting their cycle bests. We're using verified arithmetic and real-world mechanisms that I have literally watched play out on the trading floor.
Here is our roadmap for today's diagnosis. We'll quickly recap the capstone, walk through the desk life cycle, identify the 3 leading indicators of drift, go over an essential 10-point checklist, and finally, talk about the immense power of early detection. Okay, moving right into Section 2. The L&D desk life cycle. Let's look at how a desk's health actually evolves over time. This curve beautifully illustrates the medical arc of a trading desk. We start in a cautious build phase, where everyone is finding their footing, and then move into a highly competent peak. But inevitably, the desk enters the silent drift phase. And this is the danger zone, right? The business fundamentally changes. Maybe your originators start trading new geographies, or the risk team starts layering on crazy complex structured products. But your original controls just sit there. They don't adapt. Notice there are no years on this horizontal axis. A desk can drift within just 3 years of a reorg, or it can hold its peak for a decade and a half under solid leadership. Chronological age doesn't matter. The hidden symptoms are what we're looking for.
Now, the grand irony of this drift phase is that from the outside, it looks absolutely spectacular. The board sees record profits, everybody gets a massive bonus, and they're popping champagne. But under the hood, the reality is shifting. Overrides on your safety limits are stretching out longer and longer. Shadow systems, those massive rogue Excel spreadsheets running hot on a scheduler's laptop, are multiplying like rabbits. By the time you actually hit decay and suffer a massive operational incident, that drift has been happening for years, and the architects of your original controls are probably long gone.
Which brings us to Section 3, the 3 indicators of drift. So how do we actually measure this hidden disease?
Well, the good news is you don't need to buy expensive new software to find out. Look at this composite case study. That dashed line, that's the reported P&L. To the executive board, it looks totally flat, perfectly healthy, maybe even ticking up a bit. But check out our 3 indicators diverging sharply right underneath it.
Override days, cost to reach flat, and shadow systems. They are absolutely skyrocketing. The reported financial results are completely masking a drastic mutation in the desk's actual risk profile.
Now, we absolutely have to draw a structural contrast here between the US and the EU. These two desks answer to different regulators, they price against completely different benchmarks, and honestly, they fail in totally different ways. A US desk mostly acquires permissions, things obtained once and checked per transaction, like pipeline capacity. So, a US desk drifts by quietly building shadow Excel sheets for complex pipeline tolling and feed gas multipliers, usually because their main system just can't handle the physical reality of how much gas is needed to produce 1 unit of LNG. On the flip side, an EU desk mostly acquires demonstrations. These are things like emission certificates or origin documents that must be legally reproduced for every single cargo. So an EU desk drifts by granting endless daily overrides just to clear operations paperwork and avoid delaying a vessel at the terminal.
So just how bad can this get while profits still look okay? Well, in our case study, the overall override count grew by 800%. Not great. But the override days outstanding, which actually measures the accumulated time and distance between your hard limits and the business, grew an unbelievable 133 times. Literally, 133 times. That is a massive, silent accumulation of risk completely ignored because everyone is glued to the daily P&L.
Let's break these three down quickly. Override days outstanding tracks the exact time your safety limits are suspended. Cost to reach flat measures the hidden drift up the obligation ladder, meaning you're having to make increasingly complex concessions, like layering on weird indexation swaps, just to neutralize your physical position while your baseline numbers look perfectly still. And the shadow system count exposes the literal gaps between your official ETRM and daily reality. The really tough truth? All three of these rise when results are good. To catch this disease early, you have to force a highly profitable, successful desk to explain itself, and they will not like that.
All right, Section 4, the 10-point checklist. Once we know what to look for, what's the treatment plan?
Take a look at this radar chart. Notice the massive gap between the green line, representing a truly durable desk, and the orange dashed line of your typical desk. We're looking at key controls like decomposition, trigger prices, and flow aggregate. The absolute best part about this? 8 out of 10 of these controls require 0 new software and 0 new budget. None. They rely entirely on records you already have in your system right now and strict, disciplined decisions about authority.
But here's the catch. Having all 10 points on a checklist doesn't mean a thing if you mess up the sequence. Sequence matters way more than completeness. You absolutely must have these 4 specific controls, like a mandate on 5 axes and trigger prices, locked in place before your very first trade. If you try to define trigger prices after the desk already has a sprawling, complex book, human nature guarantees those triggers will just be retroactively tweaked to justify the risk they've already taken. At that point, it's not a boundary, it's just a ratification of past behavior.
Finally, Section 5, the power of early detection. This is the ultimate payoff of this entire module.
The most common misreading of this program is that a perfect, error-free trading desk actually exists somewhere out there. Let me save you some time. It doesn't. In the physical reality of LNG trading, where boil-off gas is constantly venting and terminal schedules are clashing, failures are always chains of events. A durable desk doesn't somehow magically prevent all errors. Instead, it catches the defect at the earliest possible link in that chain.
And this number right here is why that matters so much. This is the prevention-detection ratio. Based on our verified arithmetic, intervening at link 2 of a failure chain, say catching a scheduling mismatch before the vessel even loads, might cost you around $15,000. But if you lack the controls and you wait until link 4, that exact same defect explodes into a $10.4 million loss.
The defect didn't change at all. Your latency in finding it did.
And we see the exact same magnitude when it comes to time management. Correcting a defect right at the time of trade capture takes 1 single hour. Digging up that exact same defect during a messy, dragged-out settlement dispute months later, that takes 260 hours. Across both money and time, your desk's survival is dominated almost entirely by how early it looks for the disease, not how thoroughly it audits the corpse after the fact.
So as we officially wrap up Module 1 on running a desk, I want you to look at your own operations and ask yourself this final question. If a sudden plant outage removed 2 of your cargoes tomorrow, how much would reducing your position cost you today compared to 3 years ago? Honestly, if you can't answer that question using data you already have at your fingertips, your desk might be in drift right now. Thank you so much for joining me for this explainer. Next up, we are going to dive deep into the physical realities of the value chain as we kick off Module 2, LNG Market Structure. I'll see you there.